Hello and welcome back to the channel. Living on dividends here. Hope you guys are having a great day. And today we're going to talk about average down investing versus consistent investing, the Misty comparison. So, what is this video about, right? Um, so basically, let me see. Oh yeah. So basically, I want to start using like new terms in the community because the traditional terms don't really it's not really applicable to us. We like people talk about dollar cost averaging, and that's not really what we're doing, right? And you can go look up the definition of dollar cost averaging, but it's really just doing the same dollar amount over time, and over time you're gonna average your way into the market, and you're not like trying to buy low, sell high, or try to time things. So, but what we're gonna try to start doing is using averaging down, right? That's one of the main things people like to do is averaging down, and this is gonna be like a super extreme case where it's like if you have the ability to predict the market 100%, um, with like a like you're working a job so you get a consistent income, we're just gonna take a look at how you would fare versus like consistent investing, right? So we're just gonna call it averaging down or average down investing. That's the new term I want to coin. But consistent investing is you get paid every 2 weeks, so every 2 weeks you get paid, and then you put the money in the market because you're trying to build up your position over time, right? So just consistent investing. You're not trying to like time things and be like, oh, it's down today, it's up today. Like you're just consistently over time putting your money in, making everything work, trying to build up, right? And we're just using Misty as an example because I like Misty. So here's the table of contents. So we're going to introduce the new terms, which we kind of basically already did, and we're going to show the examples of averaging down versus consistent investing, and then we're going to look at like the comparison and give final thoughts, right? So we already talked about this. You you can use margin, or you can just use cash or whatever. But basically, you're just looking for when the stock price goes below your average, right? So like if you pay $20 for a stock, for like 1,000 shares of a stock, and then it goes down to 18, right? You're gonna buy more to try to lower your average, right? But if it's above 20, then you're not gonna buy it because you don't want to increase your average. So it's just averaging down, right? And you can only do that when you have available cash to buy more shares. But if you use a margin, then you won't, you don't have cash. But anyways, so what is the benefit, right? The main benefit is that you get to buy more shares for the same amount of money because the price is lower. The other benefit is you get to lower your cost average to improve further future capital gains, right? So it goes down to 18, you buy it at 18, then it goes back to 20. And well, now you've made $2 a share, right, on 1,000 shares. So, and then you're at break even on your initial 20. So, so you're improving the future capital gains, assuming the stock market goes up all the time, which we all know. In general happens. Get a long enough period of time. And then number three is to increase your yield on cost, right? So the yield on cost is you pay less money for the same shares. Well, now all of a sudden your yield on cost is gonna go up. So you might have a higher yield in your portfolio than what everyone else is getting because the price has changed and the yields went down. But your price is locked in at that lower rate. What are the cons? So your money isn't in the market working for you, right? So there could be a time where this stock is like above your average. It could be above your average for 5 months, 6 months, a year, right? So all that time you have money just sitting around collecting dust because you're trying to average down and wait, right? So your money isn't in the market working for you, making more money. And number two, you might have to wait a long time, right? So if you have to wait 6 months, well, that's 6 months you're not getting income. So that's less income per year during that time while you're waiting, right? You're gonna be doing less money than other people who are just investing. And then the loss of time spent analyzing to find the right time to jump in, right? So you're just sitting here trying to look at things every day, every week, or whatever, and that just takes time, right? You have to look at your average, look at where it is, see when you want to do it, how much you want to do, how many shares you want to buy. Is it going to be worth? You don't have to spend time doing all that if you just did a consistent, right? So, and then obviously we already talked about the missed payments, right? Every month you wait, this less months of payments, less takes more time for you to get your return on investment back, right? So there's that. So consistent investing. This style of investing involves investing at a regular interval. It's similar to dollar cost averaging because you're just investing uh, over time, like consistently, right? In the market every month, you're gonna buy into the market. But this new term is for income investing because we also want to look at how the yields are changing month to month, right? Because we're all about high yield investing. So we're not just consistently going to invest in like Misty, right? If Misty's yield is dropping, we're gonna switch over to Nvidia because Nvidia is still above 100%. Misty's only at 90, right? So we're gonna be looking at that. Or if Bitcoin's going down and Misty's going down, we're not just gonna keep investing in necessarily, right? We might switch over to something that's higher yielding at the time. So it's not just dollar cost averaging. It's also like doing a little bit of analysis to make sure we keep our high yield investment strategy. So the benefit is that your portfolio is growing over time because you're constantly putting money in every month, right? Every month it's going to go up by $500 every month. At the end of the year, you're going to have $6,000 in your portfolio, right? So it's going up. Increase your income every month. Obviously, you're buying more shares, so every month your income's going to be coming up from that dividends. You free up your time, especially if you're dripping or investing in the same ETF for a while. If you just turn on drip, you can just deposit the money in, and especially if you're like M1 Finance or something, and have it automatically buy the same stocks, and then when the dividends come in, they automatically reinvest in the same stock. So you don't have time sitting around analyzing and doing all this stuff. You're just letting it come in automatically, just letting it grow and grow and grow. So what are the cons, right? You can purchase less shares, meaning less income, because the price could go up, right? When it comes time for you to buy, it could be up on that day. You're not looking at that, paying attention, and then you're buying less shares, so it means less income. But we're gonna see what that actually means later. Number two, the market could be down all week, up when you purchase, right? So it's the same thing, but it's just looking at like, oh, it could be $20 on Monday, but you don't buy until Friday. Friday's at 25. So now you've like lost out on 25%, right? More shares. The market could be down for months or years, causing lower returns in the short run. So obviously the market being down, is like, not necessarily a good thing because you really want the stocks to stay stable, right? You don't want them dropping because the yield is based on a percentage of the stock price. So if the stocks are going down, you're going to get lower dividends, so lower returns until it goes back up. And then you could be tempted to ignore the ETF performance instead of actively managing. Okay, you could be in complacency, right? So you don't want to like just ignore and have the prices drop and drop and drop, and you're not like making sure that you're staying positive in your investment or seeing if there's anything better you could be invested in. So the goal of this example is to compare the differences between averaging down and consistent investing. At the end, we'll see how which one would have prevailed if we invested in Misty. So the parameters are: we're going to invest $1,000 per month, and that is in $500 increments because we're going to get paid every 2 weeks, just like everyone normally does on their jobs. And we're only going to compare the total return on investment, and total dividend payments. Nothing else, because that's what we really care about most anyways. So the explanation of the events, and this is for the average, this is for the consistent investing strategy, right? So you can see that we started off in February. Misty launched in February on like the 22nd. So in the month of February, we would have got paid on the 8th and the 22nd, and we would have received $500 for each of those, so $1,000. And then On that same day that we received our paycheck is when Misty launched, and the launch price, I guess, was 2038 according to the 52-week low high. Now, if you go back and look at any stock chart, the price is gonna be like 21 something, but I'm just gonna use the entry price and assume we got it the entry. So the best possible thing. So we were able to get 49 shares at that launch price with our $1,000. So the next month we get paid on the 7th and the 21st. We were able to purchase 15 shares on the 7th and 12 shares on the 21st. So if there's no dates on the right side section here, that means we bought it on the day we got paid. So we got paid and we immediately bought the shares. So this is just showing all the prices that at the end of the day we bought the shares, that's the price. So that's the price that I put on here. So we got 15 shares and 12 shares. We got paid on the 4th and the 18th. And on the 4th, oh, no, this is the average down version. So, okay, so this is the average down version because on the 4th and the 18th, right? On the 4th, we couldn't buy any shares because that was the ex dividend day or whatever. So we wouldn't get any income that month, and the price was higher, right? No, I had it right. It's the consistent one. But we decided not to buy the shares because it was the ex dividend day, and we decided to wait till the next time it got paid for some reason. I don't remember why, but just go with it. So we did 34 shares at $30. Anyways, 5/2 we got paid, 5/16 we got paid, 5/30 we got paid, and we did 17 shares, 15 shares, and 15 shares. And then on 6/13 we got paid, 6/27 we got paid. We did 17 shares, 16 shares, and then on 7/11, 7/11 free slushy we got paid. 7/25 we got paid, so we did 19 shares and 17 shares. So that's how all the events went for that one. I should have put the title up there, but that is the consistent one anyways. So this is the average down version. Sorry for the confusion. So we get paid the same days, right? 28, 22nd, got a 500. We got the shares, same 49, 37, 321. We got 15 shares and 13 shares, but we didn't buy them on the 21st because here we have a full insight into the market, right? We know exactly where the lows are. And this is just a maximizer. So like you're watching the price and you want the price to go down. And you saw that it went down 322, so you decided to buy 13 shares then instead of the day before because you were waiting for it to go down. On the 4th and the 18th, it's the same thing. We didn't buy any shares on the 4th because the price is still on the higher side or whatever. Then we did 37 shares on 5/1. So we got paid on the 4th, we held the money, paid on the 18th, held the money all the way to the 1st. And then we did 37 shares on the 1st. So that's how we got. So for the comparison, if we look back at this same line, 4/4 4/18, this one says 2707. But if you go back, we paid $30 in the consistent version. So we paid $3 more per share in the consistent version than we did on the averaging down version. So that's one of the differences you can see. So they're all going to be different like that if you actually look at it. It's the same thing for the 3/7 and 3/21. So you can see that. So 3/7, 3/21, you can see that is we did 12 shares for $40 on the 21st. But here we waited, right, and got it for 38 instead of 40. So it's $2 a share less. So you can see that we're strategically buying on the less days. So, but a lot of them match up coincidentally, which is I also find interesting. So you can see that 5/16, 5/12, and 5/30 we did 17, 15 shares. But then we didn't buy them on 5/30. Went to wait till 5/31 and we got 15 shares. And then 6/13, 6/27, we had the 18 shares on the 13th, and then on 6/24, we did 18 more shares on. Wait, So I said that wrong. We did 18 shares on 624 from our 613th payment. And then we did 18 more shares on 7/3 from our 627 payment. So you can see that we got paid on 627. We had to wait till 7/3 to get in at the lowest possible point. And the other thing with this is we're buying in before the dividend because we want to get the dividend for that month. Because you don't want to wait till it passes just to get a lower number potentially. We're not doing that. And then on 7/11, 7/25, we bought those shares on the same days, just like the other one. So now I'm gonna switch to this portfolio. You can see the difference. So hold on, and it'll be instant switch for you. But hold on. So here we can see that this version is the one that's the consistent investing. Yes, the aspect ratio, I couldn't get it to turn, whatever. So you can see that after investing through July, from February through July, we end up at 6605 balance. We received, if you look at that's the total balance. And then if we look at this one, you can see that we got a total return of $1,728. And then the dividends, see, the total dividends is $1553.10. And then if we go back, at the wrong button. If we go back, so this one is 6810. So you can see it's 6605, 68. So you got 6810 here. Total value. And if we go to the dividends here, the total return is 1979. So it's 1979 to 1728, and then the dividends you can see is 1595 dividends. So what does all this mean, right? So hold on a second. Okay, so all of this means when you look at it, here we go. So here's the total return side by side. You got 2271 and 2015. So what is happening? Okay, sorry about that. So we can see that so here's the total return for the two different things, and when you do it as a ratio, the averaging down version is 11.3% better, but this is total return, right? So this includes the stock price going up. So all those little times where you bought it for $2 less or $3 less, all those add up to be just $200 more, right? Now, yeah, so that equals 11.3% better. So, but what do we care about more, right? So let's look at this. The total portfolio value, right? So the value of the stocks was 7106 and 6893. So it's only 3.1% better. Now I know these numbers look different because when I made this PowerPoint, it was a different day, and since then the stock has changed, so that's why those numbers look slightly off. But you can see that they're still close either way. And then for the dividend comparison, it was only 2.7% better. So even less of a difference, right? We received 1595 versus 1553. So you're not really getting much more dividends from buying on the lowest possible days you can buy, right? So you're better off just doing it consistently over time, and you don't have to worry about it, right? Like it's 2.7% more money, yeah, but it's not really, that noticeable, especially earlier on when you have smaller account. So what's the conclusion here? So the conclusion is the biggest advantage to knowing exactly how the stock will move only materially matters when it comes to total return, right? And that's just because that total return was 11.3% more, right? But that includes the stock price. But if you're buying these to hold them forever, you don't care as much about the stock price going up or down as you do the dividends, right? The yield that you're getting from these stocks. So if the value's up a little more, a little less, but you're still getting the same amount of money, it doesn't really matter, right? The portfolio value was close as well. It was like 3 point something percent, right? So it's close, and the only reason that matters is when you need to sell, right? This is the only time you care about your portfolio value, and we all can't reliably predict where the absolute bottom is, anyways. But it would help, obviously. You'd have more value there. But that doesn't mean that these returns were negative, right? Both the total returns are positive. So, I mean, all you care is that the total return is positive for the most part, right? And then lastly, the dividend or return of it. The dividend or return of investment, right? We call them return on investment, right? That's what we care about. It was only 2.7% difference, so it's very small. This means you can stop worrying about it and just invest, right? So that you can save time and energy knowing that you'll get your money back in basically the same amount of time as everyone else, because it's only 3% difference, right? So in theory, in the same month, you should still get paid all your money back if you're tracking that. So I don't know if you found what you guys thought about this. Let me know in the comment section about the comparison and the results. Were you surprised about how far apart or close together these things were? I mean, I noticed that a lot of the times it just happened to be that the days you got paid were the lowest days of the month or that time frame anyways. So it's like you might as well just invest on those days and not even think about it, right? So I mean, that might be what I do more. So look, moving forward, just kind of ignore the noise and just be consistent, right? And I just want to say thank you to everyone. This is not financial advice. I'm not a financial advisor. This is for entertainment purposes only. Let me know what you guys think down in the comments. Have a good day. Peace.